All 9 Bank of England policymakers voted to leave interest rates unchanged in December, as they said inflation should start easing back next year. The decision to maintain interest rates at the present level was widely expected after the bank hiked the base rate from 0.25% to 0.5% last month. It comes as policymakers said that Brexit-fuelled inflation was close to its peak and would begin to ease back towards its 2% target in the medium term, after hitting 3.1% in November. It remains the case that inflation has been pushed above the target by the boost to import prices that resulted from the past depreciation of sterling, the bank's meeting minutes said. The MPC judges that inflation is likely to be close to its peak and will decline towards the 2% target in the medium term. The bank also said that different economic indicators suggested growth was likely to have slowed down as the year ends. It expects gross domestic product growth in the fourth quarter to come in somewhat below the previous quarter's 0.4%. The Bank of England finally raised interest rates in November, more than a decade after the last upward move. The rise to 0.5% came as the bank sought to dampen inflation, but is controversial as it could slow the economy. The key question now is how quickly base rate is lifted beyond this, and the inflation report mapped out an expected path, that with rates at 0.7% at the end of next year, 1% in 2019, and then sticking there through 2020. If inflation falls away as predicted, then that route map could remain intact, but if it stays stubbornly high, faster rises may be needed. On the flip side, recession or a downward turn for the economy would slow things down. Analysts and economists were divided on the merit of today's base rate hike. Some see little as having changed to warrant the shift from a 7-2 vote to hold rates to a 7-2 vote to raise them. Others comment that this nearly takes us back to pre-Brexit vote levels, and the bank had to be seen to take action. Howard Cunningham, fixed income portfolio manager at move.The, said, given the explicit guidance at the prior meeting, the market had largely priced in today's increase, but questions remain. Is it just a November gesture, or will it develop into something more substantial in the months ahead, with further rate increases in 2018? Also, will growth be so disappointing that it will look like an embarrassing mistake and need to be shaved back off at the first opportunity? In our view, it is a worthy move, and it is appropriate to reverse the emergency rate cut put in place in August 2016, both to allay any complacency that rates will never go up, and also to signal that too much inflation will not be tolerated. However, I am less convinced that further tightening is imminent, and anticipate that inflation should begin to decline, with a possibility that Brexit uncertainty may weigh on economic activity. Today's interest rate rise was widely expected after signals at the last MPC meeting, and the Bank of England doing little to dispel the belief that rates would go up. In fact, had rates not gone up today, the bank would have lost credibility in many quarters. Some do not believe that more rises are wise. However, Matthew Britton, investment analyst at Salem, said, "We don't think this is the start of a series of rate increases. Indeed, we believe inflation will return to target levels of its own volition as the effects of a weak sterling dissipate." The UK remains in a precarious economic position with high levels of consumer debt and the Brexit negotiations delaying investment decisions, so we think that low interest rates are helpful in keeping the economy strong. Assuming the inflation outlook stabilizes, we think this is the first and last interest rate hike we will see for a while. Some have also warned that there are other factors that need to be taken into account alongside rates, including the successor to funding for lending that pumped cheap money to banks and allowed mortgage rates to be slashed. Chris Derbyshire, Chief Investment Officer, 7IM, said, "The Bank of England has raised base rates, but that's not the full story." The monetary stimulus put in place following the referendum comprised the base rate cut, a reduction in the counter-cyclical capital buffer rate, plus the term funding scheme, scheduled to terminate in February. It was the combination of these three actions that produced the formidable boost to bank lending following the referendum, and it was the willingness of consumers to borrow that has powered the economy over the past year. With defaults in unsecured lending ticking up, however, the Bank of England has decided to start taking away the punch bowl. While these changes will impact relatively gradually throughout the year, they represent new headwinds. The question is whether the strong economic momentum seen outside the UK can carry across the English Channel, or whether the British economy will suffer another year of lackluster growth. So why has the bank raised rates now? The most recent Consumer Prices Index inflation figure was 3% for September, and the rise in the cost of living has been running above the target level of 2% for most of this year. Much of the inflationary effect seen this year has been imported due to the fall in the value of the pound since the Brexit vote. As long as the pound doesn't take another major tumble, inflation is expected to peak soon at about 3.2% and then tail off. Raising interest rates will make little difference in this scenario, but the bank has taken the decision to move, and we seem to be doing something about inflation. How high will rates go? The Bank of England Governor Mark Carney has offered many reassurances over the years that rate rises would be slow and well signaled. Any diversion from that path is likely to spook borrowers, businesses and the markets. The inflation report looked as far out as 2020 and then stopped. At that point it suggested base rate at 1%. The new normal for interest rates in this cycle has been judged to be about 2%. Whether they get there before a recession remains to be seen. The inflation that Britain has seen in recent times has been largely driven by shifts in the pound. The CPI rise is expected to peak perhaps as early as October, at just above 3%. What did the Bank of England say when it cut, laying out its interest rate decision in August 2016? The Bank of England said the following. Simon Lambert explains what it means. The cut in bank rate will lower borrowing costs for households and businesses. However, as interest rates are close to zero, it is likely to be difficult for some banks and building societies to reduce deposit rates much further, which in turn might limit their ability to cut their lending rates. Translation: we are cutting rates because lower costs will encourage households and businesses to borrow more, encouraging banks to create more money for loans and keep money flowing into the economy. As rates are so low, the effect may be limited. On its new term funding scheme, which looks like funding for lending to borrow. In order to mitigate this, the MPC is launching a term funding scheme, TFS, that will provide funding for banks at interest rates close to bank rate. In addition, the TFS provides participants with a cost-effective source of funding to support additional lending to the real economy, providing insurance against the risk that conditions tighten in bank funding markets. By paying financial institutions for safe haven government bonds we give them money that we hope will be invested in more risky assets, such as company bonds and shares, and encourage borrowing and lending. On buying up to £10 billion of corporate bonds, purchases of corporate bonds could provide somewhat more stimulus than the same amount of gilt purchases. In particular, given that corporate bonds are higher-yielding instruments than government bonds, investors selling corporate debt to the bank could be more likely to invest the money received in other corporate assets than those selling gilts. In addition, by increasing demand in secondary markets, purchases by the bank could reduce liquidity premia. and such purchases could stimulate issuance in sterling corporate bond markets. Having initially formed its forward guidance on interest rates around unemployment, the Bank of England switched tack when this fell far faster than expected. It identified the somewhat nebulous concept of slack in the economy as one of the new deciding factors on when rates would be ready to rise. It is also keeping a keen eye on wage growth, and the global economy.The Bank's 2013 August inflation report unveiled forward guidance Mark 1, which said the bank would not consider raising rates until unemployment fell to 7% or lower. At that point, unemployment stood at 7.8%. It promptly dropped like a stone, yet rates remained on hold. Forward guidance Mark 2 arrived in February 2014. It put slack on the agenda, identifying that spare capacity in the economy meant that it could grow at a faster rate without requiring rates to rise. The bank says that some of this slack had been used up, but there had actually been more of it than first thought. There is now little forward guidance on where rates are headed beyond the usual pronouncements. Figures were skewed by Manox Lloyd's Banking Group and Royal Bank of Scotland winding down their historical loan books, and Spanish giant Santander easing back on its former mortgage expansion policy. One group undeniably hit very hard by funding for lending has been savers. Returns on savings accounts have dived since its launch in a race to the bottom that has seen big cuts in the best deals on offer. Swap rates in money markets versus mortgages and savings. When markets move a decent amount, and the move holds, it can affect the pricing of some mortgages and savings accounts. When swaps price the rate rise to come sooner, fixed-rate savings bonds tend to marginally improve in the weeks that follow. This is Money has always advocated caution with any sort of prediction, including our own. There's no guarantee that those who have made correct calls in the past will make them in the future.